Let's look at the financial landscape right now. Across the board, markets are reacting to a compounding series of global uncertainties and geopolitical shocks that are making everyday investors nervous. Much of this traces back to the conflict in the Middle East involving Iran, which has severely disrupted transit routes and sent global energy prices climbing. Higher oil prices ripple through the entire supply chain, keeping inflation stubbornly above that target 3% threshold. It's what economists call sticky inflation. To combat that persistent inflation, the Federal Reserve is maintaining a tighter grip on the economy, pushing back expected rate cuts and keeping interest rates elevated through at least 2027. When borrowing costs stay high and energy gets expensive, corporate profits take a hit, stock valuations drop, and the balance of your 401k starts to shrink. This sudden volatility triggers a paralyzing fear of duration, the specific panic of wondering exactly how long that money will be gone. Historically, a standard bear market, defined as a drop of 20% or more, lasts about 11 months and erases 32% of a portfolio's value. But the real nightmare scenario is a U-shaped recovery. Think back to the global financial crisis of 2008. After that crash, it took the S&P 500 nearly 6 grueling years of sideways, sluggish growth just to reclaim its previous peak. But a static market index and an active retirement account are different financial vehicles. They operate by entirely different mathematical rules. If you look closely at the internal mechanics of your 401k, the mathematical reality of your personal recovery is much faster than the grim timelines flashing on the news. Your 401k is built on an automated engine called dollar cost averaging. Every time you get paid, a set amount of money buys into the market, regardless of the current price. During a market downturn, those bi-weekly contributions don't stop. Instead, your fixed dollar amount is suddenly purchasing a significantly higher volume of shares at a steep discount. Because you're accumulating so many cheap shares during the slide, the overall cost basis, the average price you paid for your investments, plummets alongside the market. This creates a powerful coiled spring. When the broader market eventually bottoms out and merely starts to tick upward, that massive volume of cheap shares causes your total account value to surge. This is where the timelines diverge. Because your average cost is now much lower, your personal 401k balance crosses its previous all-time high well before the overall market index fully recovers. You don't need the global economy to completely heal in order to be made whole. You just need the system to keep running. Grave. There is only one thing that breaks this mathematical advantage, and it's our own psychology. When investors watch their balances drop, the instinct is to stop the bleeding. They halt their bi-weekly contributions or move their remaining investments into cash right at the bottom of the crash. This chart shows the daily performance of the S&P 500 during U.S. bull and bear markets since 1942. If you look at the sharpest upward spikes, the data reveals that 24 of the 30 best market days in history happened during acute crises, grouped directly next to the worst days. Missing just the 10 best days over a 20-year period slashes your annualized returns by nearly 40%. The recovery happens in a flash, and if you are in cash, you miss it entirely. Trying to outsmart a crash by pausing participation is a specific behavioral trap that locks in permanent wealth destruction. Looking at the 2026 economy, the geopolitical headwinds dragging the market down are fighting against massive structural tailwinds, primarily the rapid economy-wide integration of artificial intelligence and new data infrastructure. Whether these forces collide to create a rapid V-shaped rebound or a long, drawn-out U-shaped recession is impossible to predict and entirely outside of your control. Macroeconomic forces dictate the shape of the global market, but your personal recovery timeline is dictated entirely by your consistency. If your retirement is still years away, you have to completely reframe how you view a market downturn. For anyone with a long-term retirement horizon, a market crash acts as a critical, necessary wealth accumulation event. The most profitable action you can take right now is to ignore the dropping balance, close the app, and let the automated engine run. Ultimately, surviving market volatility comes down to trusting the math of the 401k engine and refusing to panic.